What's up, everyone? It's Karthik with MoneyVest. We've got a lot of data and a lot of technical analysis to unpack in this video. We do have the CPI numbers coming out in less than 5 hours, and these right here are going to be some of those expectations for the July CPI forecast. So Bank of America headline CPI expecting at 0.25% with 3% year over year. You'll notice that majority of these banks and institutional investors are expecting 3% for year over year headline CPI. And then just a few banks expecting an even more optimistic and bullish report, like for example, Piper Sandler, TD Securities, UBS, and Nomura, expecting the headline CPI year over year to sit around 2.9%. But the median forecast is indeed 3%, so almost every bank out there is expecting for inflation to hit the forecast and be aligned with where we were in the previous report, increasing anywhere from 15, 16 basis points to as much as 20, 25 basis points. Now, you might be wondering, how can CPI month over month be up, let's say 0.13% or 0.14%? or 0.19% and 0.25% at the same time, and the year over year sitting perfectly at 3% in all circumstances. It's all because of the seasonality adjustments that these banks may be doing, and of course the BLS, Bureau of Labor Statistics, also does, right? So they're the ones that actually report the numbers. But I've also done an inflation video in the past going over the overall grid and the CPI index and the month over month increase or decrease and what that does to the year over year number. So make sure that you do check that out as well. And core CPI, the median forecast is going to be 0.19%, so just under 20 basis points with 3.2% expectations for year over year. Now let's dive right into the technical analysis of things, because the markets are coming up to a very, very big test. And I really wanted to break down some of the important technical analysis for NASDAQ and for Magnificent Seven, because at the end of the day, I feel like those are the indices, or those are the sectors or set of stocks, I should say, that are really going to dictate where the markets end up going, right? Are we going higher, lower? It's this set of stocks that are going to really determine market direction, in my opinion. So what we have here is the overall Magnificent Seven. So you got Apple, Amazon, Tesla, Nvidia, Meta, Google, and Microsoft. And since 2015, this has of course been on a very, very nice uptrend. This is the overall chart for Magnificent Seven that I've created on my TradingView. A few times you could argue that we were, of course, very, very overbought. We were kind of trading in this blow off the top rally here for Magnificent Seven, which as a result, obviously we came down during the bear market of 2022. And since that low from October of 2022, we've seen a very nice recovery back up for this entire index. But overall, generally speaking, we have seen a very nice consistent uptrend of moving higher in a very healthy, stable, uptrending market, also validating perfectly the 50 simple moving average. So this right here, I believe, is the 50 or maybe 150. We'll have to take a look at it in just a minute. So this is the weekly time frame. So weekly time frame, the 50 moving average, we have perfectly validated. And in the past, you'll notice that every time we have sort of broken down below this, that has acted as a bit of a resistance for this particular index, and then of course resulted in more selling pressure to the downside. And right now we're perfectly validating this support very nicely as the markets are getting bought up here in 2 consecutive weeks in a row. So this particular index was up last week after selling off quite aggressively last Monday after the volatility spike. And so far this week, we are up very nicely, up over 2.6% for this particular index. And this right here is a little bit more of a granular daily chart. And this was the bear market of 2022. As you'll notice, lower highs and lower lows, consistent downtrend, and then perfectly validating this moving average, which I believe is the 150 simple moving average. So we got a double confluence, not only on the weekly time frame, but also on the daily time frame. This particular index, and more specifically QQQs as well, getting bought up really well from that moving average. However, if you come over to the 50 SMA on the daily chart, we're now coming up to this resistance. So this right here is going to be the big test for the market. Are we going to be able to recapture that moving average and push back up? Or if this is going to act as a little bit of a resistance for Mag 7 and we are going to sell off, get rejected, and roll right back down. Because in the past, this level has acted as a bit of a resistance here. You'll notice, boom, right there. We rejected. We weren't able to push back up. This right here, a combination of both the 50 and the 150 simple moving average. This right here, once again, not able to successfully break out and broke down even further. But once we really did, right, this right here was a breakout above that 50 simple moving average, then of course it started acting as a bit of a support. As you can see that we broke out, and then that level started acting as a bit of a support once again twice over here. a little bit of fluctuations over here, and then once again very nice support level here, a little bit of a breakdown, but the 150 SMA came in for the rescue, and we essentially pushed higher to new all-time highs. So this right here is a perfect example of how the 50 SMA broke down, as you can see here, but the 150 acting as a very good support, and now we're back up to the big test between the bulls and the bears. We'll see if those levels continue to get validated, if that's a resistance for us, or if that's going to be a bit of a support for the 150, and we break out to potentially new all-time highs. This right here is on the 30-minute time frame, so a little bit more shorter time frame. And what you'll notice is we left a gap here, which the market essentially filled, but got rejected very, very nicely. So this right here was a bit of a lower high. Then we left another gap here. The markets came back up to fill that entire gap. So a couple times we have left these gaps, which the markets have filled very nicely. But the overall overarching trend here is still very much lower highs and lower lows. So I think I want to be very clear here that yes, we've made some progress. We have started to make maybe some higher highs and maybe some higher lows. So yes, on a very shorter time frame, you can make a case that markets are indeed making some nice uptrends, but at the same time, if you look at the 30-minute time frame since the July peak, July all-time high, we're still within the context of this lower high and lower low. And of course, we got two different scenarios, one over here, one over here. Both of them are going to be with a different future for the markets. One of them suggesting for a bit of a breakout above this previous high. That's going to be a resistance sitting roughly under 1900. So that's going to be that resistance. And the other one, of course, getting rejected here and at that moving average, the 50 SMA, and of course, selling off even further, making new lower lows. So time will tell what exactly ends up happening. Inflation numbers, of course, are going to play a big role, because if you come in a bit hotter than what the expectations are, then there is a possibility for us to, of course, rotate back lower. But if that report is echoing the very report that we got from PPI, then there is a possibility for a bit of a breakout, and of course getting past this previous high, officially making a higher high and moving up very nicely within 2 to 3% of their all-time highs over here. So those are some things to keep in mind, because this index is very, very important for market direction, because the Magnificent Seven companies combined are worth trillions of dollars, almost a third of the S&P 500, and they're the ones that really dictate where the markets end up going. So let me know in the comment section down below if you believe in scenario number A. So this right here is going to be the first scenario. So that's going to be scenario number A, or if you believe this right here is going to be the fate for the market, which is going to be scenario number B for us moving forward. So let me know in the comment section down below, what do you think, scenario A or B? I personally do, again, believe that there is some momentum and some volume coming in. And from a long-term perspective, I do believe that yes, scenario A is going to take on over, and we're going to see breakouts and all-time highs. But of course, in the short term, I wouldn't be surprised to see some more potential downside, considering there is some weakness. There are both for and against. There's a lot of indicators that we're looking at, but at the same time, I wouldn't be surprised if volatility stabilizes a little bit. Now we're going to switch over to the VIX in just a minute, but I wouldn't be surprised if we do get a bit of that rejection from these levels and start rotating back lower, because we are on a win streak. We've seen 4 consecutive days of green, which is very good, which is very solid. But at some point, we're going to see some weakness, some pullbacks, and some profit taking in this market, because right now, this is a trader's market. We are in nice little downtrend. So investors are, with a long-term view, can continue to buy, continue to dollar cost average, but this is at the very core a trader's market at the moment, as we are seeing a very nice recovery, a bit of a technical rebound from those lows from last week. Now this right here is QQQs, a very similar pattern. This right here was the bear market of 2022, so lower highs and lower lows. Then of course coming in with a very nice uptrend of higher highs and higher lows, bouncing off of that 150 simple moving average. A couple times we validated that level very, very well, along with that uptrend of that green line that you see on the chart. And this right here also suggesting for the very fact that we were very oversold on the RSI. On the MACD, we were L3 banker oscillator. Everything was suggesting for a nice little technical rebound from those levels for QQQs. So that is, again, what we are witnessing. But on the 30-minute time frame, on shorter time frames, exactly alike to Magnificent 7, as you'll notice, lower highs and lower lows. And this right here is, once again, scenario number A and scenario number B. Let me know in the comments section down below, what scenario are you expecting from the markets moving forward. So that right there is scenario number A and scenario number B, whether we're going to see lower lows or are we going to see a bit of a breakout beyond this previous high for the markets as well. And of course, don't forget that we also have the 50 SMA for QQQs also coming up, where we have gotten rejected. So you'll notice that this right here was a little bit of that resistance for QQQs, and we're going to be coming up to that resistance once again moving forward. So that's going to be that level to watch very, very carefully. It's going to be sitting roughly at around $472.54. That would be the level to watch for QQQs. Now, coming over to some really important data and, switching gears to over volatility. Volatility is a very, very important metric for all of us on the channel. We've looked at VIX many times. We've talked about when the VIX is high, it's time to buy. When the VIX is low, it's time to go. We participated in the buying opportunities from last Monday when the volatility was spiking to over 65, 180% increase. It was a bit of a flash crash for the market, down almost in a correction, almost 10% from its all-time highs. So those were buying opportunities for us. So I want to be very clear. Does this market have any weakness or any potential vulnerability for us to see that scenario be lower lows? Yes, there is a possibility, because at the end of the day, nobody really knows where the markets are going, but we trade and invest on probabilities. I think it's really important for everyone, especially new beginner investors, to understand nobody knows where the markets are going. We trade and invest on probabilities, not on certainties. We trade and invest based on probabilities. And what is the most probable outcome over the short term, medium term, and the long term? So this right here are some of the charts. Shout out to Charlie Belio for putting these together. And what you'll notice is every time you've seen volatility spike, the largest 3-day percentage increases, which in fact this was the third largest increase going back as far as I believe 1990s. And again, I've talked about this in my previous videos as well, that we did see the largest third increase in history for over 33 years for volatility if you account for the previous calculation of volatility. So then we actually have a fourth largest increase in the VIX dating back to as far as 1987, the Black Monday being the largest increase in volatility. But this right here, getting up to over 135%. Every time it's happened in the past, every time you've seen at least a 60% increase in volatility, the forward 1-year, 2-year, 3-year, 5-year returns have been very, very strong for the S&P 500. Extremely strong, right? This is in entirely gray because we don't know what the forward returns will be. But average, you'll notice of all time periods, we've seen anywhere from 12 to as much as over 74%. So that is the return for S&P 500 on a forward basis. For top 20, we've seen anywhere from 18 to as much as almost 90% in forward returns for 1, 2, 3, 4, 5-year period. But of course, this is not perfect. A couple times we've seen markets not do well. 2007, for example, volatility spiked almost 80%, getting up to over 18, which at that point, even 18 was pretty high. We saw 2-year and 3-year returns still down 44, 15%. So markets didn't quite recover all the way back up to all-time highs, and we didn't quite see any returns during a 2 to 3 year period. So nothing is 100%, nothing is perfect. But again, the probability is very, very high. So now we talked about the returns for 3-day percentage increase. Let's talk about 4-day largest increases, which it was one of the largest, and we have seen declines, of 47%, meaning the volatility getting up to as much as 65, it has now come down significantly. So after the third largest spike that we witnessed for volatility, we have also now witnessed the fourth largest 4-day percentage decline since 1990, and that is a 47.2% decline. And once again, if you take a look at the forward S&P 500 returns, it is very, very strong. I mean, it has almost always been a buy signal for when the VIX is high. The other day, obviously, I got a comment in my videos that when the VIX is high, it's time to buy as a fail strategy, because the VIX can always go higher. And that to me was, a little bit unreasonable, because it's like saying buying stocks when they're low is a fail strategy because they can always go lower. And that's true. Obviously, anything can go anywhere at any time. Volatility can keep going higher, stocks can keep going lower. But what we are trying to understand here is what is the probable outcome of things and how they're going to potentially play out as they have played out in the past. Once again, coming back to probabilities and coming back to the risk and reward that the market really offers us. And this right here is, again, 73 to as much as 99% returns for the market on a 5-year basis. 5-year basis, we already know the probability for profit is extremely high. And a 2-year, 3-year, 4-year basis, also 27 to as much as 63% for the market. So in most cases, as you can see, there's so much greenery over here across the board. There's this green all the way. It has been buying opportunities for the markets in general. This right here, solid S&P returns 13, 26, 39, and 52 weeks after the VIX spike. This is a study from Bank of America, also suggesting that percentage percentage of times that were up, 80% of the times, 90% of the times, 80% of the times, 80% over here between 13 and 52 weeks after the VIX spike that we have witnessed. So the probability for success very high as a buyer, and the median average returns anywhere from 5 to as much as over 18 to 14% for the market. And I believe this study goes back as far as 1992. Now, this right here is another report. So now that we have understood the percentage returns, right? So in other words, the forward returns for the S&P 500, let's try to understand the probability of those returns. As I mentioned, everything is based on probabilities. This is from Jay Capel on Twitter. Considering all trading days when VIX index closed above 38 or higher, S&P 500 12 months later, higher 96% of the times. Now that is some probability here. 96% of the times the S&P 500 is higher 12 months later, and median 12-month return of just under 25%. So every time you've seen a VIX spike here, as you'll notice a couple of times, this is going back as far as 2009. This right here, again, 2000s and 2006, 2007. This, of course, 1987. This right here is the 2020. And this right here was the most recent spike of 2024. Every single time has been a buying opportunity for us, for investors to take advantage of that long-term momentum. Now, can the markets go lower and VIX can spike again? Yes, they absolutely can, right? Absolutely. There's no doubt about it. That's on the table. It's a possibility. But our idea here is to understand risk reward, understand when it actually makes sense to be more aggressive, when it makes sense to buy the fear, buy the panic, not sell the fear, not sell the panic, buy the fear, buy the panic, and when we can take advantage of those opportunities. This right here is S&P 500's annual performance versus percentage of days with a trading range of above 1%. And what you'll notice is that right now we're right over here at 2024. Despite the recent bout of volatility, 2024 still has less than 33% of days with a trading range of over 1%. So it's still been a pretty muted year, 2024 overall, because we haven't really seen a lot of big 1% days or 2% days. So we're still within a very, very low volatility environment, because VIX for the most part was pretty dead. I mean, it was trading as low as 12, 13, 14. We were talking about it for days and weeks, and finally we got a big spike, and of course everybody freaks out. But this is a very normal functioning market. This was actually healthy for the market for us to see that big spike getting up to over 65, which restores confidence among traders and investors that this is a healthy functioning market and something that is actually functioning as it should. This is a very normal occurrence in the markets moving forward. And Barchart also reported that traders invested $210 million, which is not a lot, but still a record inflow for XLG, which is the top 50 NASDAQ companies. So S&P 500 companies. So S&P 500 top 50 ETF XLG on Monday, the largest one-day inflow in history. So lots of buyers stepping in for this particular ETF, the top 50 in the S&P 500, so $210 million, even though it's not a lot, but it's still a record inflow for this particular ETF. This right here was also really, really interesting chart. Shout out to FX Evolution for posting this. The August to September corporate repurchase window is historically strong. So this is mostly the corporate authorizations, corporate buybacks, and corporate repurchases estimated at over 1.15 trillion worth of authorizations and 960 billion worth of executions. We currently estimate, and this I believe is from Goldman Sachs, we estimate that 90% of the S&P 500 is in the open window and closes again on September 6th. Corporates will likely take advantage of this dip with $4.75 billion worth of daily purchasing power until the closed window. So that has historically been a very, very strong sort of catalyst for markets to move higher in general. This 2-month period is the second best of the year with a 20.7% of executions. Only November and December are higher with 21.1%. So second best time for corporates to buy back shares, repurchases, and that has historically been the time for when, of course, the markets are also lower. They're also cheaper, and as a result, corporates are able to buy their own shares, at a discount. But at the same time, insiders are not really buying. So when we're talking about individuals and executives, corporate insiders didn't buy the dip. So we are seeing another chart from Barchart. Insider trading activity followed the smart money. And right now, we're not really seeing a lot of net buying activity from corporates. We've also learned, a lot of insiders selling stock, Warren Buffett selling stock. So, by the way, August 14th, tomorrow is also the last day and the deadline for filing for 13F filings for all institutional managers managing over $100 million worth of assets. So we're going to learn more about what the insiders and, of course, institutions are doing with their portfolios. I'll break that down in more detail, but there's definitely both cases for and against. For insiders, it could also mean a lot of different things for not buying those dips. Maybe they are, net sellers of the stocks right now. They are buying, but they are collectively on an aggregate basis, maybe net sellers for many different reasons. Could be derivatives, could be options, futures, could be already set aside automated selling for those insiders. So that, in my opinion, is not a big signal, more of noise at the moment. And finally, we come over to, what is going to take place in September. Federal Reserve is coming in with a rate cut, as we already know. But if it's accompanied with a recession versus not a recession, that's really what's going to dictate markets' momentum moving forward. If there is a recession, there is expectations for the markets to come down. But if there's not a recession, of course, markets are going to be expecting a soft landing and some quantitative easing on top of that, expecting very, very nice returns moving forward. So this right here is the breaking point. After the 25-50 basis points, as the markets are expecting in September, we're going to be on one of these two paths. Number one is going to be this right here, depending on recession or not. Number two is going to be right over here. So let me know in the comment section down below, what path do you expect us to take, one or two, post Federal Reserve's rate cut? Because that largely is going to depend on whether we see a recession or not. And recession-wise, I've already mentioned the probability is quite high, because we are seeing a lot of indicators and a lot of signals that are suggesting for a recession, but at the same time, there are indicators that are suggesting for against a recession, because unemployment continues to be low, productivity continues to be high. So I think it's something that we have to learn over time as data keeps coming in. But at the moment, yes, the probability is a little bit elevated, and we're also accelerating in that direction. But right now, there is no expectations for a recession just yet. So hope you all enjoyed this video and a complete update on the markets here, a little bit of a macro/technical/CPI update. Let me know your thoughts down in the comment section below. Again, scenario A or B and scenario 1 or 2. Those are the comments that I'm expecting in this video. As always, happy investing. I'll see you all in the next video.